Silver just crashed harder than it has in years, and if you think this was just another market correction, think again. What if I told you this wasn't an accident? What if powerful institutions knew exactly what was coming and positioned themselves to profit massively while everyday investors lost billions? Stay with me, because what I'm about to reveal will change the way you see the financial markets forever. The evidence is right there, hiding in plain sight. And by the end of this video, you'll understand exactly who orchestrated this crash and why they did it. Before we dive deep into this conspiracy, do me a favor. Hit that like button right now, because what you're about to learn isn't being covered by mainstream financial media. They don't want you to know this. And if you're serious about understanding how the real game is played on Wall Street, subscribe to Empire Economics and turn on notifications. We're one of the few channels brave enough to expose what's really happening behind the curtain. All right, let's get into it. So let's talk about what just happened. Silver prices collapsed dramatically, wiping out portfolios and leaving thousands of retail investors stunned. We're talking about a drop that seemed to come out of nowhere. One day, silver is climbing steadily, looking like the perfect hedge against inflation and economic uncertainty. The next day, boom, it's in free fall. Now, the mainstream narrative will tell you this was because of interest rate expectations, or dollar strength, or maybe even decreased industrial demand. But here's where things get interesting. When you actually look at the fundamentals, none of those explanations hold water. Industrial demand for silver hasn't significantly changed. The dollar's movements don't justify such a violent crash. And interest rate expectations, they've been relatively stable. So what really happened? To understand that, we need to talk about who controls the silver market. The silver market isn't like stocks or even gold. It's smaller, more concentrated, and far easier to manipulate. A handful of major banks and institutions control massive positions in silver futures. These aren't small players. We're talking about some of the biggest names in global finance. Banks that have been caught manipulating precious metals markets before, banks that paid billions in fines but never really changed their behavior. These institutions don't just participate in the market, they have the power to move it. And here's the crucial part. In the weeks leading up to this crash, something very unusual was happening in the futures market. The data shows a massive buildup of short positions. Someone, or more likely, several someones, were betting big that silver was about to fall. And I mean really big. Positions so large that when they started unwinding, the market had no choice but to collapse. Now, you might be thinking, couldn't this just be normal market activity? Investors make bets all the time, right? Sure, but the timing here is just too perfect. Let me walk you through the evidence. First, look at the commitment of traders reports published by the Commodity Futures Trading Commission. These reports show who's holding what positions in the futures market. In the months before the crash, commercial traders, that's the big banks and institutions, were building up short positions at a rate we haven't seen in years. They were essentially preparing for silver to fall. At the same time, retail investors and small speculators were doing the opposite. They were going long, betting on silver going up. The setup was perfect. Big money on one side, small money on the other. Second, there's the suspicious trading activity right before the crash. Massive sell orders hit the market during low liquidity hours, particularly during Asian trading sessions when fewer participants are active. This isn't how you sell if you want the best price. This is how you sell if you want to create panic and drive the price down. It's a classic manipulation tactic. Flood the market with sell orders when there aren't enough buyers to absorb them, and watch the price crater. Then, once the price is down and retail investors are panicking and selling at losses, you buy back at a discount. It's a wealth transfer, plain and simple. Third, let's talk about the mainstream media's role in all of this. In the days leading up to the crash, financial media outlets started pushing narratives about why silver was overvalued. Articles appeared questioning silver's role as an inflation hedge. Analysts suddenly became bearish. It's almost like they were preparing the public psychology for what was about to happen. And who do you think advertises heavily on these financial media platforms? The same banks and institutions that profit from these moves. This isn't conspiracy theory. This is how the game works. So who actually benefited from this crash? Let's name names, or at least categories, because the specific institutions protect themselves behind layers of complexity. But we can identify the types of players who made a fortune. First, the bullion banks. These are the major commercial banks that deal in precious metals. They hold enormous short positions in silver futures, and when the price crashes, those positions become incredibly profitable. We're talking about potential profits in the hundreds of millions, possibly billions, depending on the size of their positions. Some researchers have pointed to banks like JP Morgan, which has a long history of being investigated for precious metals manipulation. They paid nearly $1 billion in fines for spoofing the gold and silver markets, yet the behavior continues. Second, hedge funds and proprietary trading firms with inside information or sophisticated algorithms that can detect and exploit these setups. When you have the resources to analyze order flow data, options positioning, and futures market structure at a deep level, you can see these manipulations coming. These firms position themselves accordingly and ride the wave down, making massive profits while regular investors lose their shirts. Third, and this is crucial, central banks and governments have an interest in suppressing precious metals prices. Why? Because gold and silver are seen as alternatives to fiat currency. When precious metals prices rise too much, it signals a loss of confidence in paper money and government monetary policy. By keeping silver and gold prices suppressed, they maintain the illusion that everything is fine with the dollar and other fiat currencies. There's also the derivative aspect. Major banks hold enormous derivative positions tied to precious metals. When prices move in the direction they bet on, those derivatives pay out handsomely. The complexity of these derivative structures means most people have no idea how much money is really at stake. But insiders do, and they position themselves perfectly every single time. It's no coincidence that these crashes happen repeatedly, always following the same pattern. Build up short positions, create negative media sentiment, trigger a technical breakdown in the market, watch retail panic and sell, then cover your shorts at huge profits. Rinse and repeat. Empire Economics has been tracking these patterns for years, and the evidence is overwhelming. Now you're probably wondering, if this is so obvious, why doesn't anyone stop it? Great question. The answer is uncomfortable but simple. The system is designed to allow this. The regulatory agencies that are supposed to prevent market manipulation are either understaffed, outgunned, or frankly, they don't want to upset the big players who dominate these markets. When banks get caught, they pay a fine that sounds big to us, but is just a cost of doing business for them. Nobody goes to jail. The behavior doesn't change, and the cycle continues. There's also the revolving door between Wall Street and regulatory agencies. The people who are supposed to be regulating these banks often used to work for them, or they plan to work for them in the future. That creates a built-in conflict of interest. You're not going to aggressively prosecute institutions that might hire you for a 7-figure salary down the road. This isn't about individual corruption necessarily. It's structural. The system protects itself. Meanwhile, everyday investors are left holding the bag. People who bought silver as a hedge against inflation, who believed in the fundamental case for precious metals, who trusted that the market was fair, they're the ones who suffer. Their savings get wiped out while insiders profit. And the media will tell them it's their own fault for not understanding market dynamics. But that's gaslighting. The market isn't free or fair when it can be manipulated by players with essentially unlimited resources and inside connections. Here's another uncomfortable truth. This manipulation isn't limited to silver. Gold, oil, cryptocurrencies, even equity markets show signs of similar manipulation. The silver crash is just one obvious example in a much larger pattern of how wealth is systematically transferred from regular people to financial elites. The tools vary, the assets change, but the core mechanism remains the same. Those with power and information exploit those without. And because most people don't understand the complex machinery of modern finance, they don't even realize they're being played. So what does this mean for you? Should you give up on silver? Should you avoid precious metals altogether? Not necessarily, but you need to understand the game you're playing. If you're investing in silver or any precious metals, you have to accept that the market is not operating on fundamentals alone. You're swimming in a pool with sharks, and those sharks have sonar while you're navigating blind. That doesn't mean you can't profit or protect your wealth with precious metals. It means you need to be smarter about it. Don't invest money you can't afford to lose. Don't use leverage or trade futures unless you really know what you're doing. Focus on physical silver if you believe in the long-term story, because physical metal can't be manipulated through paper contracts the same way futures can. Most importantly, stay informed. That's why channels like Empire Economics exist. We're here to show you what's really happening, to pull back the curtain on the manipulation, and give you the information you need to make better decisions. The financial establishment doesn't want an educated public. They profit from your ignorance. Every time you learn something new about how these systems work, you take back a little bit of power. Before we wrap up, I want you to do something. Go down to the comments right now and tell me what you think. Do you believe this silver crash was planned? Have you been affected by it? Share your story. And if this video opened your eyes to something you didn't know before, share it with someone who needs to see this. Post it on your social media, send it to a friend who invests, help us spread this information. The more people who understand what's happening, the harder it becomes for them to keep playing these games. Look, the truth is, this isn't going to stop. The next manipulation is probably already being planned. Maybe it's silver again, maybe it's gold, maybe it's something else entirely. But you can choose to be informed. You can choose to see the patterns and protect yourself. That's what Empire Economics is all about. Real analysis, uncomfortable truths, and information you won't get from mainstream sources. Subscribe if you haven't already, hit that notification bell, and join a community of people who refuse to be taken advantage of by a rigged system. Thanks for watching, stay vigilant, and I'll see you in the next video where we'll expose even more of what they don't want you to know. Until then, protect your wealth and question everything.